Yeah, thanks very much, Tim. And thanks everybody for joining us today. As Tim says, my name's Keith Cullen. I'm the founder and MD of WTL. Today I'm going to give you a bit of background on the company and talk about our recent acquisition of our industry peer, SENTRY Group, and then take you through a little of what's happening in the financial advice industry in Australia today, the disruption that we're seeing in the industry and how that represents a great opportunity for companies like ours. So I'll just get you to pop through those first couple of disclaimer slides for us and on to, there we go. Our first one. So about WTL, we were originally founded under the name of Spring Financial Group in 2010. And initially our focus was on delivering a range of financial services direct to consumers under our Spring Financial Group brand. So really a B2C operation where all of our advisors were salaried advisors. And look, we enjoyed great success initially, profitable from our first year. We built a terrific range of assets and intellectual property focused on advisor education and training, on consumer education and client recruitment and digital marketing processes, and a real process-driven advice creation and risk management framework. So terrific assets, high growth. We listed on the ASX initially under the code of SFL in 2015, listing under the profits test. And we had a really strong dividend history, paying out around 7 million in dividends across our first couple of years. But then fast forward to 2017 and really significant changes to legislation and regulations and to education standards, culminating in the Royal Commission, all impacted considerably, not just on the industry broadly, but very much on the company as well. And it forced us to have a real rethink. So the board and shareholders determined that it was best to bite the bullet and shift our thinking from being primarily a B2C operator to really focusing on business to business. And we thought that would enable us to leverage all of those assets that we built within our B2C business and offer those out to independent financial advisors, which is where we saw that the opportunity was going to sit into the future. And so that strategy saw us dispose of a number of our B2C assets and really scale back a lot of our fixed overheads. That program of scaling back those fixed overheads has really just been completed in the last several months as we've run off the leases on a number of our B2C buildings and office accommodation, etc. Central to our shift to B2B was our acquisition in 2018 of Wealth Today. And Wealth Today comprises a group, or when we acquired it, it comprised a group of what was then about 40 independent financial advisors. And we were providing them a comprehensive range of services, compliance, education and training, tech support, practice management and business development, etc. And the real driver to that was that we saw in the wake of the Royal Commission that there was a quick unravelling of the traditional vertically integrated model where banks had bought up all of the dealer groups to aid their distribution of their products. So what we did with this shift was we turned what was industry disruption on the company on its head, and instead of it being a burden to us, as we've been capitalizing on it. So leveraging all of those assets as we organically grew Wealth Today to around 120 advisors across 105 practices. And we've significantly grown that further. If we pop onto the next slide now, please, with our acquisition of our industry peer, SENTRY Group. So SENTRY had been operating for more than a decade. It had built to a position of around 155 advisors across around 100 practices. And so a pretty significant operation. Bringing it together with us now as we're sitting with around 275 advisors across 200 practices. We acquired SENTRY for an initial payment of $7 million. There could be a further back-end payment of $3 million. I certainly hope there is, because it's a performance-based payment that will be relative to SENTRY hitting certain milestones. We satisfied the acquisition payment 50% shares and 50% cash, with those vendor shares all being escrowed for a period of 2 years. We also raised an additional $1.5 million of cash at the time to fund not only transaction costs, but also integration costs. And that acquisition settled in July. look, the key to the acquisition is not only the complementary nature of the two businesses, but also operational efficiencies. And we've already implemented significant cost reductions from those synergies, and there's some more potential savings to go. And the acquisition's been very accretive to earnings. It's taken us straight into profitability. The integration of systems and processes across both SENTRY Group and Wealth Today practices has been very well received by the advisors in both camps. And look, despite the lockdowns presenting some challenges in getting things integrated, we're really pleased at the progress that's been made and the reception that we've had sort of industry-wide, but also across the existing advisor cohorts. So I think it's fair to say that the execution risk on the integration of the operations has been met. We're out the other side of that, and the executive and the operational teams have dealt with it very well, particularly under these lockdown circumstances. So, of course, we've been in discussions with SENTRY for some time, and after announcing the deal in June, there was a 1-month delay to the settlement while we sought shareholder approval for the issuance of the shares associated with the transaction. So we had a fair bit of time to plan for it and get ready for merging the operations. So I'll just pop through to the next slide now. It really is a very complementary and transformational acquisition for us. The board and management team has been expanded greatly. And look, I've got some slides in here today that talk to the board and management team, but we've announced these, and I'd urge everyone to have a look at our previous announcements to get a good feeling for just the terrific experience that both the executive team and also the people that have joined our board associated with the transaction have brought to the table. I think really for SENTRY, it was a sell in rather than a sell out of their operations. And so from that perspective, it's been viewed more as a merger, and we've really been able to broaden not just the advisor base and revenue and profitability, but also the executive team and the board as well. So we'll just pop through to the next slide. Well, we'll skip that one, I think. Yeah, good one. Just having a look at the sort of shape of where this places us now and what's happening in the industry. This is that rotation that I talked about of the sort of disintegration of the vertically integrated model. You see NAB and CBA and Westpac and ANZ have really all exited the industry down to zero. AMP and IOOF remain the two big of the original big six that are there still with that vertically integrated model. And these numbers on the right-hand side of that slide sort of show where we're now placed in terms of our peers. You'll see sort of around us are a number of both listed peers in the likes of Sequoia and Centrepoint Alliance, as well as Count Plus and Eastern. And you'll see that there's some privately held peers there as well in Synchronised, or otherwise known as Synchron, Capstone, Lifespan, Fortnum, etc. So there's certainly opportunity for considerable organic growth still, as these leading independents, ourselves included, keep growing, but there's definitely transactional opportunities existing in the market, not just within this sort of top tiered group, but also well below it as the minor groups really start to struggle with, I'd say anyone under 100 advisors now is really struggling from a scale perspective, given what financial advisors are demanding of their dealer groups in this much more complex regulatory and educational environment that we're in now. So if we flip on to the next slide, people will ask, why would you be investing in financial advice at a time when the industry's had so much disruption? The reality of that is that the demand for advice is growing. So whilst there's significant challenges in the industry from an operator's perspective, the consumer demand for advice really makes this an incredibly exciting time to be investing in the industry. For companies like ours, there's consolidations happening as demands on advisors are increasing and they need more from their dealer groups. Central to this is we're right on the doorstep of the biggest wealth transfer in the history of this country, with about $3 trillion about to transfer from one generation to the next, really increasing that demand for advice. So we'll flip on to the next slide. A couple of slides here. Michael Harrison's joined us, Rob Jones has joined us. Both of these gentlemen came to us from SENTRY. They've both been involved in the old Shadforths that sold into IOOF, considerable merger and acquisition opportunity. Flip onto the next slide. And our management team's been complemented, our new head of finance and our new joint COO, David Newman and Rickton Jones. joining our Frank Paul and Jack Standing to really round out our executive team. And the next slide, and I think that'll get us close. Quickly wrapping up before Q&A. It's some key things from a financial perspective. We're targeting $70 million in gross revenue for the year, might be a bit more than that, and our net profit after tax guidance is for in excess of $2 million. That'll be an accounting profit. We've got tax losses to use up, so we're really looking forward to being able to deliver for shareholders this year and drive some growth. Critically, we cleaned up the balance sheet significantly at June 30. And so we're really well positioned to deliver those numbers. There you go, Tim. I think that was about on 10 minutes.
Right. I reckon that was bang straight on 10 minutes. Thanks, Keith.
Good on you.
Can you talk a little about your growth prospects? Is the idea to increase the revenue per advisor, and how do you balance that with acquisitions as well?
Yeah, really good question. I mean, I think key to increasing the revenue per advisor is making the advisors more sticky. And it's certainly something that we're very good at within our business from all our B2C experience. I will note we've retained the core of our B2C operations. And I think this important point of difference for us is we call it our research and development lab. It really enables us to retain within our DNA what it means to be sitting in front of clients every day. So we don't need to theorize what the impacts of changes to regulation or legislation or product opportunities are in terms of the direct-to-consumer piece. We live it every day. And so we're very focused to help our advisors drive their overall revenue. The reality of that is that has less of an impact on our net profit position, because most of our fees are made up of a fixed component that advisors pay us, with only a smaller component made up of participating in their variable. But it's an important value add to the advisors, is really helping them be profitable and strong.
And is the real key driver acquisitions?
Look, I think it's twofold, Tim. The driver to margin is definitely incremental growth through attracting new practices into what we're doing. And in that regard, I'm pleased to say we've really built best of breed for advisors. The bringing together of what SENTRY had from its practice management and practice development programs it was running, with our really tailored risk management framework that makes advisors be able to be very compliant in a much more commercialized manner, is really offering best of breed out there to advisors, and we're attracting practices because of it. But there's definitely acquisition opportunities, smaller ones that are good bolt-ons that come without much cost structure to them, and there's definitely some larger opportunities out there as well.
There's a question here. What debt does the WT Financial Group have at the moment?
Yeah, good question. We've got around $3 million in debt in total, and we're comfortably dealing with that with both a pretty aggressive amortization program that's paying it down and also comfortably servicing it out of cash flow.
Another question here. There seems to be a lot of one-man bands in kind of financial planning businesses. Are you worried they'll kind of leave the industry altogether?
Yeah, I'm not really. I mean, I know a number of the larger operators kind of have this negative view towards financial planners that are operating, out of serviced offices as a 1, 2, or 3-man band. But there's a real place for them in the market, and we're really comfortable supporting them. What we've seen is a lot of advisors exit the industry over the last couple of years that really were doing it as an adjunct to another business, or they were semi-retired, having sold off a part of their business, and they've not wanted to deal with the change to the education requirements and so on. But I think most of that has sort of shaken out now. And so I think that the industry will be pretty stable now. It's more about getting some new young blood into the industry as well. And but we're comfortable supporting the smaller operators. They really need the sorts of framework that we can offer.
And can you talk through, you raised some capital obviously to buy SENTRY. Can you talk through who the new institutional investors are, and can you talk to your own ownership in WT Financial and also other management within the group?
Yeah, sure. Good question. Well, I think it's a really important point for any small or micro cap company like ours is how much skin in the game do the board and management have? And in this regard, board holdings are around 26% of the company. And then there's an additional 10% held by executives of the company. So you've got board and management holding, well over a third or just over a third of the company, which is fantastic. We've then got institutional shareholders holding about 35% of the company, and then the balance is held by retail investors. We've got around 500 shareholders in the company. This last transaction was backed by existing shareholders that were on the register, which was Ariadne Limited, an institutional shareholder. We also had Glennon Capital come into the transaction. And then we had a new shareholder come on, which is Summers Limited. And Summers Limited are sort of a major holder in what was Home Loans Limited, which is now Resimac. They've got about 50% of that and many billions of dollars under management. So it's a really good, strong institutional register that we're building, and great support we've seen from them. We also had some of our longer term shareholders back us, and we've got McCaff Microcap Fund on the register as well. So it's a good mix of insto, retail and board and management.